Hello again. We're going to start off with chapter 5, the first video. That's right, 5.1. And this is inventory purchases. And for the second video in chapter 5, I'm going to do inventory sales. So this whole chapter is about inventory and various aspects of it. And in fact, the next chapter also deals with inventory, but we're looking at purchases and sales for this chapter. So in this particular video, what we're going to do is actually cover a couple of inventory non-specific items for the first couple of points, and then the last couple will be specific to purchases. So let's talk a little bit about inventory. I actually have 8 points that I want to go over here. And the first one is when we're talking about classifying companies on what type of a business is, there in accounting and finance, we think of it, of course, they can be separated in many different ways, but the way that we look at it in accounting is there are 3 types of companies. And these classifications are based on inventory. So our first type of company is a service company, like a lawyer or an accountant or something like that. No inventory. Could even be things like Netflix. They're just providing a service. They're not selling you any physical items. Then we have a group of companies called merchandisers. Now, you might think of them as retailers or wholesalers, but what they do is they buy and sell. And I'm going to call this finished goods. And what I mean by that is, you know, when Walmart buys something, they don't buy something, then change it or add to it. They just buy it as is from the manufacturer and then turn around and upmarket and sell it. So there are no changes. They buy something that's already a finished product and then they sell it on. And this can be both retailers who sell to the end user, to the customer, or it could be wholesalers, people who are buying from another company and then selling it on and marking it up. So a wholesaler is sort of a business to business sort of thing, and a retailer is a business to customer. The last type is a manufacturer. Now, a manufacturer is buying something and changing it. In other words, think about like a car company. They're buying, raw materials. They're buying components to a car and they're assembling it. They're creating something new. So manufacturers make things. They don't just buy and sell finished goods. And therefore they have different types of inventory. What type do they have? Well, they have raw materials. Now it can be as raw as coal and steel, or it could be raw materials as in it's a component that you buy from someone else, like a computer manufacturer. They probably buy the case from someone, the motherboard from someone, the hard drive, and then they assemble it. So the raw materials can be actual raw materials, or they can be just components that need to be assembled. Then during the month of the year, if you're not quite finished assembling something, you have work in process that you need to track. In other words, this is the unfinished goods, and then you have the finished goods. Those are the basic categories that a manufacturer. So they have 3 different types of inventories at a minimum, whereas a merchandiser only has one type, finished goods, buying and selling finished goods. In this particular book, we're going to, at least for the time being, we're going to be focusing on merchandisers and looking at it from a more simple one type of inventory point of view. If we go on and we talk about a merchandiser and we say, what is a merchandiser's biggest expense? What cost do they have to worry about the most? Well, their biggest expense is going to be the inventory that they buy and sell, right? So in order to be sure about, how much we're spending on inventory, if that's our biggest cost, we keep track of it fairly closely. And in fact, when we sell inventory, we call that an expense, but we actually have a special name for it. So if we want to know what the profit is, how much profits we've made, we need to know both the sale price, like if we sold something for $100, and we need to know our price. Maybe we bought it. Our wholesale price was $40. So when we sell it, we make a $60 profit. Well, this wholesale price is, you can think of this as the cost of the inventory, right? And remember, anything that we use up in generating a sale is considered an expense. In fact, we don't just say cost of the inventory sold. That's kind of what we mean. We actually use the word cost of goods sold. And we abbreviate it as COGS, C-O-G-S. And remember, this is an expense. In other words, anything that's used up in generating revenue. And when we say we used up, we no longer have the inventory, right? When we sold the inventory, we gave it away. It's no longer in our inventory. So don't think of it as used up as we ate all the Pringles. If we sold a bunch of Pringles. Okay, so other operating expenses are other operating expenses. These are the next biggest category for a merchandiser or retailer. Other operating expenses, and these would be things such as wages, rent, utilities, insurance, that sort of thing. Okay, so we've got three different types of companies. We're focusing on merchandiser. Their biggest expense is inventory, which when we still have it, we call it inventory. It's an asset. When we sell the inventory, we call it an expense. We call it cost of goods sold. So it's just inventory is pre-sale. COGS is the same thing, same item, but post-sale after we sold it. Number 3. Well, as you can imagine, the buying and selling of inventory kind of follows a regular cycle. So let's take a look at this regular cycle. So it's buying and selling. And as you can imagine, whenever you're in business or anything like that, you're trying to make things as efficient as possible. And just remember, I'm going to talk about a cycle here, but the time scale may be different depending upon the product. It's dependent upon the product or the industry, and we'll talk a little bit about that in a second. So in general, we start off with, okay, we spend a little cash. Cash goes out. We buy inventory. The inventory gets shipped to us, and maybe it goes to our warehouse. A lot of times I abbreviate that WHSE. It is sitting on the shelf. Right? It's sitting on the shelf, maybe in the warehouse or in our store. It gets sold. It gets sold. And let's say, for argument's sake, that we're selling things that are, let's see, is this a little bit? I guess it's okay. We are selling things and we're selling them on account. So this becomes an account, right? An accounts receivable. And we then wait to collect that, right? Because they don't pay us this back right away. But once they do, it becomes cash in. And then the cash in can start the cycle again. We can spend that cash now. So sometimes it's worthwhile to try and shorten this cycle, whichever way. In other words, we don't want goods sitting on the shelf. So maybe we don't buy as much inventory. Maybe we don't allow customers to have 90 days. We require them to pay us within 30 days. But however we do it, we can go about trying to figure out how to shorten this cycle, because this cash to cash cycle is important to businesses. Okay, next thing here is a lot of things when we're talking about inventory, we're going to be dealing with this particular idea, the inventory equation. Now I'm going to show you the basic format of it, but it is flexible enough for us to use it in many different ways, and we'll see multiple ways over time. And how it works is you start off with beginning inventory, and then you add in any purchases, and that has to equal COGS, which is what you sold, right? Plus ending inventory. And how do I mean that? Let's take something that's a big ticket item. Let's say we're selling, we have a small dealership and we're selling trucks. You can pick your type of truck. So let's say we start off and we have 5 trucks on the lot. We buy 2. And at the end of the month, I go out and I count that there are 3 left. Well, how many did I sell? Well, if I had 5 and I added 2, this equals 7, right? I had a total of 7 that I could have sold. And if I'm left with 3, I must have sold 4. So it doesn't matter which of these numbers that you have. If you have 3 of the numbers, you can figure out the 4th number. So a lot of times sometimes we're figuring out what's the ending inventory. Sometimes we're figuring out purchases, sometimes COGS. And as long as you understand how this equation works, you can figure out the number without too much difficulty. So just realize this is the beginning amount. This is the ending amount. COGS is what is decreasing inventory. It's leaving inventory because we're selling it. And purchases are increasing inventory. So there's stuff coming in, there's stuff going out, and then there's the beginning and ending amount. Now we call these two together, we call these goods available for sale. In other words, at any particular time, the maximum amount of trucks that we had were 7. Okay. Let's move on. We've got another point here, number 5. And we're going to talk a little bit about 2 different types of inventory systems, periodic versus perpetual. Oops, I kind of wrote those backwards. Let me do this. Perpetual versus periodic, because I want to talk about perpetual as being the primary one. Perpetual is the one that we normally think of. So perpetual is equivalent to what we see nowadays in stores, modern scanning, right? Everything is scanned, not scamming, scanning. Whereas periodic are sort of the old time registers. As an example, there are other type of periodic systems, but as an example. So here with modern scanning, every time you scan it, what goes into the computer is it knows what the sales price is, so it can determine revenue. It can figure out what the cost of goods sold is. In other words, it not only knows the sales price, it probably knows the wholesale price. And it keeps track of inventory. It tracks the inventory, at least on the computer. It has a computer amount. Whereas this one, when we sell something with the old-time register, all we know is the revenue. What happens is, in order to, and remember, think about this equation. So, beginning inventory plus purchases equals COGS plus ending inventory. If from a periodic system, we know what our beginning inventory is, we know how much we bought and put out on the shelf, but we don't know how much we've sold until the end of the month when we go through and we actually do a physical count. We physically go in and count everything. And if you've ever worked in a store that does that, it's not as much fun as it sounds. And it doesn't sound like much fun. So we count the ending inventory. And what do we decide? We say, well, what is missing? What's missing? Well, we probably sold it. But did we? Is that accurate? It's not really accurate, because in addition to selling stuff could have been miscounted. It could have walked out the door. It could have been broken. So it's not a very accurate system to say, okay, I know what I began with. I know how much I purchased. I counted the inventory at the end. I'm hoping what's not there is what I sold. Whereas with the perpetual system, you keep track of all that. Now you still do a physical inventory, but the physical inventory is more of a double check. You're double checking the number that's already in the computer. And if it's a little different, if there is a difference, then you say, okay, that's what we call shrinkage. Shrinkage is, let me add that E, is a number of things. It could be theft. It could be breakage. Now, we were talking about other types of, maybe if you're in a grocery store, maybe it's waste, things that went out of date. But in other words, you have a much better idea of what is in shrinkage. Whereas here, you're just assuming everything you must have sold, or if you suspected that there was some theft, you have really no way of quantifying it. Here, at least you have a quantifying between what the computer thinks you sold and what the physical inventory says you sold. And so it's a little bit more comprehensive in being able to manage your business. Okay, let's keep going. Whenever I don't pay attention and the computer times out. Let's see. There we go. Okay, so we're going to keep going and we're going to talk about another inventory thing, which is called freight in. And freight in is, let's just take a basic example. Let's say you bought something off of Amazon for $20. And let's say the shipping was $5. Now, if you want to make a $10 profit, do you sell it for 30 or do you sell it for 35 if you want to make $10 profit? Well, you've got to sell it for 35, right? Because the shipping is it now becomes part of the inventory cost. And that's kind of what we want to look at here, is that if we want to make that $10 profit, we have to consider shipping as part of the overall price. Even though the individual item was only $20, the shipping gets included. So our all-in cost in the inventory account includes, and specifically we're going to say freight in, not freight out. Freight out is an expense. That's an optional expense for us, between us and the customer. So freight in, so these freight in gets included in the inventory account as part of it, and freight out is a separate expense. Now, how can you tell if there is shipping and whether or not you're responsible for it? Because sometimes the seller pays for the shipping and sometimes the buyer pays for the shipping. So how do you tell? Is a separate expense, separate cost. So we've got these things where we're going to talk about, they're called terms of trade. These are just normal contract trade terms that you deal with your vendors or your other business customers. And they're going to be, the ones we're going to look at are going to be called, I'll start off with the first one, FOB shipping point. Now, FOB, don't worry about it too much. It's just an acronym. It means free on board, and it actually dealt more originally with goods being put on a ship, but it can mean goods being put on any sort of carrier, any sort of shipping freight person. So you have the seller, and remember we're looking at purchases, so we're actually the buyer in this case. We're the buyer, and the goods get transported. But who is responsible for the shipping? Well, if you have the terms of trade in your shipping contract, in your purchase contract, that it's FOB shipping point, well, shipping point is the place where it leaves the seller. And in fact, this is the point where the transfer of ownership happens. In other words, once it leaves the seller, according to FOB shipping point, it is now the buyer's goods. And therefore, the buyer is responsible for the shipping cost. And so this is where we would say that's freight in, and we would add it. Now, if we had another term of trade called FOB destination, well, it's still the same buyer-seller arrangement, except that destination means the buyer's location. So destination here would now become the transfer ownership point. So therefore, the seller would be responsible for the shipping. Now, are they going to increase the price of the goods? They probably are. So even though we're not paying a separate shipping cost, it probably gets embedded in the price somewhere. Okay, so let's take a look at our last two items, which are our actual purchase items. So we have a purchase, return, and allowance. These are two separate but related things. So when we buy something, a lot of times if there's something broken or it's the wrong item, we can return it. But what does the journal entries look like that? So returning means we actually physically return the item. But if we get something bad, and sometimes the seller says, okay, we'll credit your account, we'll mark off that cost, but you just keep it. We don't really want it. And that's an allowance. We're kind of looking at it from the return point of view. The allowance is essentially the same. It's a little different on how the seller handles the inventory. So let's say we purchase something. Let's say this is the original purchase, and we bought $1,200 worth of inventory, and we bought it on accounts payable, $1,200, and we discover that $200 is the wrong item. $200. So what are we going to do? We're going to return some of it, right? Well, it's just going to be the reverse of this. We're going to knock off, remember AP is like our bill. We're going to knock off $200 off our bill, and we're going to return the $200 worth of inventory items. And what does that leave us with? Well, you can imagine we have an inventory T account, which started off at $1,200. We returned $200. And how much do we have? We have $1,000 worth of inventory, which is good because if we look at our AP account, we started off with our bill being $1,200. We knocked off $200 because of the return, and therefore we owe $1,000. We owe $1,000 because that's how much inventory we kept out of the original shipment. So that's a return. And an allowance would be the same, would be written up the same way. It's just we wouldn't actually physically send them back the goods. So the next purchase description, or the next purchase item, is a purchase discount. And this is another terms of trade, another term. In other words, it's another one of these standardized ways of dealing with your business partners. So just like FOB shipping port or FOB destination is kind of a standard term of trade when you're dealing with when you're dealing with your business partners, your vendors. This is another one. Now, remember, we spent a little bit of time talking about the cycle that we have cash out, then all these things happen before we get cash back in, and then we can buy inventory again. Now, maybe it's worth it to us that maybe we normally give a customer 30 days, they buy inventory and the seller says, I'll give you 30 days to pay us. Or they may say, maybe I'll give you a discount if you pay me faster, a small discount, but it's worth it to the seller to get their cash faster so they can buy new inventory and move on. So a purchase discount is just a way for the seller to get their cash faster and for the buyer to get a little bit of a discount. And this is a common way it's written up. And it stands for, it's read 210 net 30, and it stands for you get a 2% discount if paid within 10 days, or net, meaning kind of the balance, the rest. If you don't take advantage of the discount, you have to pay the full balance in 30 days. So let's take this particular thing. We bought this inventory and we returned some of it, but it's still not 10 days. So normally, let's say if we didn't take a discount, we would normally pay in this fashion, right? We would normally say, okay, I've got an AP of 1,000 and I'm going to have to pay that off. So I would do a debit to AP of 1,000 and I would pay it off with cash. But what if I took a discount? What if I did pay within the 10 days? So we still need to clear all of this AP, because once we pay, even with the discount, we're basically saying whatever money we pay with the discount is still going to wipe out our total bill. So 1,000. But how much cash are we actually going to pay? Well, 1,000 times 2% equals $20. And so 1,000 minus $20 is $980. So even though we're going to pay our full bill of $1,000, we're going to only use $980 because we're getting the discount. So where did the other $20 come from? Well, we're reducing the inventory of 20. So what ends up happening is that our inventory is worth $980, right? I would put $20. My inventory would be worth $980, and that's how much cash we spent as well. So our cash payment and our inventory value would be the same. Okay, this one went a little long. It's just a lot of stuff. I will push this out to YouTube, and I'll get the next video up. Thank you. Talk to you soon.